Hello everyone and welcome to the M&A Tax course by Mergerverse. It's been a long time. I've been busy in some other things, but we start again. So today we are going to be covering a topic of waterfall. Now, waterfall is an important aspect in PE funds and sometimes in the portfolio companies of PE funds as well. So let's understand what's a waterfall. So if you see a waterfall, it's water falling down from top of the mountain straight down to the ground, and it goes through levels. So in fund structures also, the funds which come into the fund, or like once you do the liquidation, the returns are then go through step by step. So first part will go to someone, then the second part will go to someone, and then third, and then the distribution goes through, and it is dependent upon the valuation, the time period, and other examples. So in general, how things goes is the investor or the third party investor outside who does not have control over the fund of the business of the fund or the company will have control over the, rather will have the priority over the distribution. So they will want a priority in the way that they get the principal amount they invested and some return over that before the founder or the management or the employees or the people in control of the fund get a chance to get some return. And then once they get their return, then the next the next line may go to the founder or management, or it may go to employees and then to the equity shareholders or the founder. So now how does the waterfall get managed? So it will be done in the way of instruments that are issued to different kind of shareholders, and in general you will have convertible instruments being issued to investors so that they can get a priority over others. So now how does priority work on equity instruments? So equity shares are the lowest priority in any scenario in liquidation or anything else. Then above them are the compulsorily convertible CC preference shares, and then there is optionally convertible, and then there are redeemable preference shares which do not convert into equity shares. So this is how the priority will go, and in general the return on CCPS and OCRPS can be fixed or can be linked to a valuation, whereas equity return will be depending upon whatever the valuation and then whatever everyone else takes away. So in today's video we'll take a look of by an example. So I've prepared a simple example for you. In this scenario, there is a fund and there are just three people to whom the return has to go. One is an investor, then there is the management, and there is employees who will get ESOPs based on if the fund gets the desired liquidity valuation. And now in this example we are sort of divided. So investor has got invested 300 million USD amount into an OCRPS, and that has the first priority. Then the management will get CCPS class A, which will have second priority, and they have an IRR of 11%. Then investor has further invested 100 million in a CCPS of class B, and that's third priority, followed by return for employees in CCPS class C, and then equity shares to be held, that is held by management. And the investment by investor was made in 1st April 24, and the management started it 1 year back in 1st April 2023. Now if we see the terms of these instruments, so for the OCRPs the terms are simple. Either they get 3x amount of the investment or 10% IRR compounded monthly, and OCR, so these are OCRPs, so they can either convert into equity shares or they can be redeemed in cash. Then the second one is class A CCPS, which is held by the management. Their terms are simply 11% compounded annual return after the OCRPS are paid. So first priority will go to OCRPS. If the OCRPS value, let's say the IRR does not cost 3x, is 900, and the value of the fund is also 900, then only the OCRPS instrument will get, and the rest of them will not get anything. Then once OCRPS are paid full, then they will get, class A will get the priority, and they will get 11% IRR on their 10 million investment. Then we have class B CCPs, and their return is 11% IRR compounded monthly, but after both OCRPS and class A CCPs are paid off. So if, for example, after, let's say we are in 2025, so the value of the firm must go above 900 plus 10 million into 11% IRR for 2 years. So around about 13 million plus 900 million. So around 939 or 14 for the investor to start getting any return on class B CCPs. Once these CCPs are paid off, then comes the turn of class C CCPs, and their terms are simple. They will get 5% of whatever is left after all these three are paid. So if, let's say, these three combined get 1.1 billion for a random number, and the total value is 2.1 billion, then out of the remaining 1 million they will get 5%, which is 50 million, and whatever is left will go to the management in equity shares. And this is also the investment amount. So employees did not make any significant investment because this was more like a ESOPs structure which was given to them through a CCPS, and then the equity is given as 1 million. So now what is the waterfall look like? So we start. So currently valuation we can take. So we are taking a valuation of, let's say, 2.5 billion, and we are doing the valuation on 31st March 2026. So how will the waterfall work? So first of all, the OCRPS will get the preference over the rest, and so they will get 300 billion, which is the amount they invested, plus the return on that. So it will be higher of 3x of that, so that is 900, or 300 plus 20% return. For the OCRPS, the 3x is higher than the IRR rate, which comes to around 146 currently compared to 600. Then we go to liquidation for CCPS, which has the second preference in the liquidation or the liquidity event, and their return is pretty simple, 11% per annum compounded annually IRR. So it comes to 3.68 because they invested in 1st April 2023. So they have done 3 years of investment. Then we go, so they get total 13.68 out of $2,500 million. Then we go to class B CCPs, whose terms are 11% IRR for monthly compounding. So they've done 24 months of investment from 1st April 24 to 1st April 26, and their return comes out to be 24.48 million. So they have 124.48 out of 2500 through CCPS class B, and then the balance now remaining after these two classes of CCPS and OCRPs are paid off is 2500 minus these three is coming out to be $1461.8 million, out of which 5% will go to class C CCPs, which are held by the employees. So they get 73.09 million USD, and this balance of 1388.7 goes to equity shareholders held by the management. So now we have the distribution summary. So OCRPs went to investor 900 million, then class A went to management 30.7, then class B went to investor for 124.5 million, and then employees got 73.1 million from CCPS class C, and then the equity shares got 1388.7. And so if you see, the investor invested 400 million and they get 1024.5x 5 return, so that is 2.6x. The management only invested 11 million, but they got 1402.4, so they get a 127.5 because they had the control. And if the valuation is below, let's say, 1 billion, then the management will not get much return out of this, and the employees get a 73.1 million. That is obviously because they were part of this, they played a role in getting the fund to this 2.5 billion valuation, and so they're rewarded as part of ESOPs through class C CCPS. And if we look at this shareholding table here in assumption sheet, it also shows the investors total holding comes out to be 41%, and management comes out to be 56.1%, and employees comes out to be 2.9%. And if we keep increasing the valuation, let's say we go to 4 billion, then the employees and management stake increases to 70.7 and 3.7, and investors decreases to 25.6. and if I change this to 2 billion only, then the investor gets 51.2% of the equity value, whereas the management gets only 46.4%. And if I remove the data validation from here, and if we can lower the valuation to say 1 billion or 1000 million, then you would see that the investor is getting 102.4%. That means the terms provide for more than the value of the company. So in such a scenario, all of the $1 billion will go to the investor, and these two will not get anything. Obviously, these answers are incorrect, because in the waterfall shield we did not build formulas for negative scenarios. This was assumed to be over $2 billion valuation, the working that is prepared here. But you get the point. So basically, the investor in this fund structure would want to have this safety of their principal and return prior to management and employees getting anything out, or founders in certain examples, so that they are protected for downside. And if everything is good and there is a lot of upside, then the management is obviously the one who will get a huge amount on their investment, or on the much less investment compared to investors. As you can see, in this case, management at 4 billion valuation makes 257x of their investment amount. And if you want to get more into the waterfall video, you can also watch the convertible instruments video which I made prior to this, and you will be able to understand how different kinds of instruments such as OCRPS, CCPS, and other debt instruments, convertible debt instruments, work in Indian scenario. So thanks for watching and have a good time.